Hey warriors, I hope you're all doing well. So yes, we are done with accounts and law. We are moving on to the next exciting paper called as taxation, and I'm sure you're all doing great job until now. I'm not going to be wasting much time, people. We are going to get into the same groove as what we are in the previous exams. We're going to blast off taxation for this time, and therefore I'm here with a very short video for us to discuss some important things in your direct taxation. My only small request is that you watch this video after you're completed with first time reading of your syllabus, so that you can relate to what is happening here, and then we can cross compare as to what you're doing better. So yes, top 50 adjustments which you should be taking in mind before you're going for your exams. Let's see how much of this are you able to get it along with me. First, when you're starting with your first chapter called rates of taxes, the first important thing for you to keep in mind is that when you have a surcharge rate enhancement of 25 to 37%, these are not applicable on what items? These are not applicable on 4 items. You are not going to take it on any long-term capital gains under 112A. You're not going to take it under long-term capital gains of 112. You're not going to be taking it on short-term capital gains under 111A, and you will not be taking this on dividend income. You will not be taking this on dividend income. These 4 incomes are not liable for an enhancement surcharge of 25 and 37. They are eligible only for a maximum surcharge of 15%. Adjustment number 2, the tax rates of a foreign company. In the current year, an amendment of the current year which comes and clarifies you can only take a tax rate of 35% for a foreign company. Yes, the tax rate for a foreign company has been dipped down to 35% in the current year. The tax rates which are given for capital gains, if it is a transfer before 23rd July, you will take the tax rate as 20% if it is 112. You will take the tax rate as 12.5% if it is 112A. You will take the tax rate as 15% if it is 111A. But if it is going to be after 23rd July, you're going to be taking the tax rate as 12.5% for 112. You're going to take the tax rate as 12.5% for 112A. And you are going to be taking it at 20% for 111A. Please note carefully that for the 112As which are there both together, you can claim a maximum exemption of 1.25 lakhs. Yes, a total exemption of 1.25 lakhs can be claimed for both together. It is not individually. Pay attention to that. Then if you go to point number 4, which is the DTR rates, the current default tax regime rates, people, what is it? It is 0 to 3 lakhs 0, 3 lakhs to 7 lakhs 5%, 7 lakhs to 10 lakhs will be 10%, 10 lakhs to 12 lakhs will be 15%, 12 lakhs to 15 lakhs will be 20%, and after that directly 30%. You are also liable for a rebate, where you will be granted rebate under default tax regime. If your total income is up to 7 lakhs, you will be granted a rebate of 25,000. Please note very carefully that for the current year there has been a miss out, and therefore you will get a total rebate of 25,000 rupees even if your total income is up to 7 lakhs. You do not have to restrict the rebate to 20,000 rupees. You can claim up to 25,000 rupees worth of rebates. What is marginal rebate? Income tax says that if your income is going to be anywhere close to 7 lakh rupees, approximately 7 lakh 25,000 and forward, then in that case you can claim something called as a marginal rebate, where you can report the excess income as a tax payable, and you can close the answer there itself. Where can you not claim rebate? You cannot claim rebate if you are a non-resident. You cannot claim rebate on 112A incomes. So if you have any long-term capital gains under section 112A that has to be paid tax, you cannot claim rebate on those. Last adjustment, basic exemption limit, if it is not utilized, can be used for what? Income tax says that if you're going to have a basic exemption limit which is not utilized by you, you can claim it against all your capital gains. Only if you are a resident individual. Please notice carefully that you cannot claim this if you are a non-resident, and you cannot claim the basic exemption limit as a utilization for all your winnings and unexplained income. Yes, so this is your first chapter on your rates of taxes, 6 adjustments. Then we are moving on to 7th adjustment from your residential status. Income tax says that if you're going to pay any interest to NR by an NR, a non-resident is paying interest to a non-resident. If it is taken for a business purpose, then it is taxable. But if it is taken for any other reasons, then it is not taxable. Please notice carefully that if this was not interest, if this was royalty, or if it was FTS, then I would still tax it under other sources. If it was for use in India. But if it is an interest, then even if it is in India, it will not be taxable. Next, point number 8, where it says business connection will not be established for 5 cases. 5 cases where you will not be taxable for business connection, people. What are the 5 cases? 1, if the operations are not carried out in India. 2, if you are going to have any collection of news and views for transmission outside India. 3, if you are going to purchase any goods for the purpose of exports. Fourth, if you're going to be shooting any cinematographic films by a non-resident. And fifth, if you're going to have a display of uncut and unassorted diamonds by a foreign company. Then we're moving on to adjustment number 9, chapter of salaries. Income tax says that if you have received any money in NRE account, it is assumed that the money is received outside India. Yes, it is assumed that the money is received outside India, which means if this money is received by a non-resident, it will not be taxable in India. Second, income tax also says that if you have received any interest on this NRE account, that is also exempt. You are not going to be paying tax on this. Yes, so look and watch out for NRE account in the current year. If you receive any NRE account, please understand that the money received is assumed as outside India. It will only be taxable if you are a resident in the current year. If you are a non-resident, I would not tax it. Any interest coming from this will also be exempt from taxes. Next, the provisions of RFA. The current year provisions of RFA come and say that if you are going to be a person who's not a government employee, and if you are owning the premises as an employer, then the employee will be taxable for 10% of the salary. If the person is hiring the house, then the employee will be taxable for 10% of salary or the higher charges, whichever is lower. Salary here means basic plus DA forming part plus all commission plus all bonus plus all taxable allowances. But the amendment which came in last year and is critical for the current year, the amendment comes and clarifies that if you are going to take an RFA for the second year, then in that case the provisions would be RFA for year 1. The provisions would be RFA for year 1 into CII of current year divided by CII of last year. Please notice that you cannot just take RFA based on salary computation. You'll have to also check for RFA based on inflation condition. So check RFA into CII in the year of current CII of current year divided by CII of past year. This is an expected question in exam. Watch out for this. Next, if the motor car is given for part official and part personal purposes, income tax says, then you have to tell me what is happening in this case. If the car is owned by the employer but the running and maintenance is borne by the employee, then I will tax 600 rupees per month if the CC is up to 1600, and if it is more than 1600, I will tax 900 rupees per month. If the car is also owned by the employer and the running and maintenance is also incurred by the employer, then the employer will be taxed for 1800 rupees per month or 2400 rupees per month, whichever is based on 1600 cc. If the employee is owning the car but the running and maintenance is taken care by the employer, then whatever running and maintenance income the employer gives will be fully taxable minus 1800 per month or 2400 per month based on the cc of the car. Yes, at any stage, if you are also receiving a driver or a chauffeur, you will also be taxable for an additional 900 rupees per month. That is what the provisions are. Then comes in your point number 12, which is standard deduction. Understand people, if you are under ATR in the current year, you will get a standard deduction of rupees 50,000. But if you are under DTR in the current year, you will get a standard deduction of rupees 75,000 in the current year. If a question comes where they have told that the income is as per DTR but are asking you to move to ATR, check whether the DTR provisions already had salaries. If they had salaries, you would have claimed a deduction of 75,000. Because you're moving to ATR, you will also have to do an additional adjustment of increasing 25,000 of income because you need to give lower deduction of 50,000. Yes, so if you're moving from DTR to ATR, give an additional 25,000 of income under ATR so that you can align to the standard deduction. Next, point number 13 is about professional tax. Income tax says that if you are going to pay under any professional tax, if the employer pays the professional tax, it is taxable. And then whatever professional tax you paid can be claimed as deduction under ATR fully. But if you are going for DTR, no deduction will be granted. This deduction will be denied to you, which means under DTR you will tax the professional tax which is paid by the employer but claim no deduction. Under ATR, you will tax the money paid by the employer and then claim a deduction. Net effect is 0. Additionally, if you have a professional tax paid by the employee himself, you can directly claim it as deduction under ATR. This is 13 adjustments till salaries. Then we're moving on to IFHP, where income tax says if you're going to have a loss from vacancy, you can reduce it from your GAV only if your actual rent for the whole year is greater than your expected rent for the whole year. In simple words, you should be a good assessee. If I take the actual rent for the whole year, ignoring any vacancy, and if it ends up becoming more than my expected rent, then I can claim the vacancy loss. I can claim the vacancy loss. Next, what is your pre-construction period? Income tax says that when it comes to pre-construction period is the date of taking the loan, the rate of taking the loan till 31st March of the preceding previous year in which the house is completed. So pay attention to this carefully, people. If my house is completed in financial year 1920, I will take up to 31st March of the preceding previous year, which is 31st March 2019. 31st March 2019, I cannot take anything in the current year. Whatever pre-construction interest you get will be allocated over the next 5 years from the date on which the house is completed. Take it for the next 5 years. Point number 16. Income tax says when you have any HP losses, in order of priority, you'll first set off against HP income. If you're not able to set off against HP income, you'll set off against salaries. If you're not able to set off against salaries, you can set off against other heads as well. But the salaries and other heads maximum set off is only 2 lakh rupees. If nothing of this is happening, you can carry forward the loss for a period of 8 years. But notice carefully that these all provisions will only apply if you are under ATR. If you are under DTR, you can only do a current year set off of HP income. All other adjustments are not allowed. Which means no adjustment against other heads. And if you cannot set off against current year HP income, the loss will permanently lapse. Under DTR. So pay attention to this fact. Then we're moving on to PGBP, people. Point number 17. Point number 17 comes and says if you're going to have any scientific research or 3580 deduction, you can claim those deduction as 100% in your ATR except on land. No deduction will be granted on land. But if you're going under DTR, no deduction will be granted under section 3580. You'll do normal depreciation. Also, under DTR, please be careful that scientific research are of two types. One is in-house and one is donations. If you are going to do an in-house scientific research, then fully allowed, no restrictions here. But if you're going to do any donations, that will be disallowed. So pay attention to what is happening in DTR. One of the favorite questions of ICA, when a DTR question comes, they will give you donations paid under scientific research. If it's a donation paid under scientific research, under DTR it is not allowed as deduction. Under ATR you can claim it as deduction. Please pay attention to that. Then point number 18 says about composite income. If you're going to have an income under PGBP and agricultural income, when it comes to T, you will split them into 40 and 60. 40 going to PGBP, 60 going to your agricultural income. If you have coffee, you will again split them into 25 and 75 if it is grown and cured. But you will split them into 40 and 60 if it is grown, cured. Your other additional two words, 4 words are there, you'll do 40, 60. When it comes to rubber, people, you will have to do 35 and 65. Please note that the lower numbers are for PGBP. The higher numbers are for agricultural income. The lower will be what is taxable and the higher will be what is exempted. Next, if you come to contribution to PF, income tax says, tell me who are you? Are you an employer or are you an employee? If you say you are an employer, you need to deposit before the ROI due date. If you deposit before the ROI due date, I'll allow it as deduction. But if you deposit anywhere after the ROI due date, I will disallow the expense. And will allow it in the year in which you actually pay the money. But if you come to employees contribution, you need to deposit it before the PF due date. If you have not deposited it before the PF due date, you will add it as income. If you have deposited, then there is no adjustment. So pay attention to this. Next comes your bad debts recovered. Income tax says if you have already claimed bad debts in the past, then you will also tax the bad debts recovered in the current year. But if the question comes and says that in the past you wanted to claim a bad debt of rupees 5 lakhs, in which assessing officer only allowed 3 lakhs. In this case, you have already taxed 2 lakhs in the past. So which means in the current year, if the question says there is a bad debt recovery of rupees 4 lakh, you will come and say in this 4 lakhs, 2 lakhs was already taxed in the past. So therefore I will only tax an additional 2 lakhs in the current year. an additional 2 lakhs in the current year. Yes, a very important adjustment. Pay attention to this. Then comes your TDS default. Income tax says that if you have done default in paying of TDS, tell me who is the recipient. If the recipient is a non-resident, you will disallow 100% of the expense. Whereas if the recipient is a resident, you will disallow 30% of the expense. 30% of the expense. Next comes your payment to relatives. Income tax says under section 48(2)(b), if you have made any payment to relatives which is considered unreasonable, it will be disallowed as an expense. But pay attention to one thing, people. This provision will not apply if it is a sales. Please understand, this provision will only apply if it is a purchase. You should be the one making an expense. If you're making an expense, only this provision will come into picture. If you're selling something to your relatives, this provision will not come into picture. Second, this provision will only come into picture if the payment is made to your spouse, your parents, or your siblings. Note that this will not apply in case the payment is made to your spouse's siblings. Brother-in-law, sister-in-law, niece, nephews and all are not covered, which means to them payments can be made unreasonable also, fully allowed, no problems at all. When it comes to cash payment, people, income tax says in normal scenarios you cannot make a payment more than 10,000 rupees in a single day to a single person. Yes, in a single day to a single person. But if it's a payment made to a transport operator, you can make a payment up to 35,000 to a single person in a single day. Yes, next. 43B payments. Income tax says there are certain payments which are notified under 43B. First critical payments are your bonus and commission. GST payments, leave encashment, any kind of use of railway assets, any interest paid to banks, all these payments need to be made before the ROI due date. If the payment is made before the ROI due date, you can claim it as deduction. But if the payment is not made before the ROI due date, you will disallow the expense and allow it in the year in which the payment is made. Second, and the amendment of last year where you talked about MS payments, micro and small enterprise. If it's a micro and small enterprise, you need to make the payment within 45 days if it is written agreement, or 15 days if it is oral agreement. If you don't make the payment within 45 days or 15 days as the case may be, it will be disallowed on the next day. And will be allowed only in the year in which the payment is made. Next comes your amendment of current year, the salary to partners. Income tax says when you have made a salary payment to a partner, check for book profits. If your book profit is up to 6 lakh rupees, you can pay salary of 90% of the book profits, or 3 lakh rupees, whichever is higher. For any additional book profit, you can pay up to 60% of the book profit. Notice very carefully where what is book profit. Income tax says book profit means compute the whole PGBP income. Disallow only one expense, which is salary, because that is what you're computing right now. So take your whole PGBP, disallow only salaries, and then tell me what the book profit is. First 6 lakh rupees, you can claim 90% of the book profit, or 3 lakh, whichever is higher. For the balance, you can claim 60% of the book profits. An amendment of current year, therefore pay attention. Next comes your threshold limit for presumptive income. An amendment of last year but was not tested and therefore important for the current year. If you are having any business or a profession, presumptive will apply if your turnover is up to 2 crores. But if you are doing your transaction 95% in permissible modes, your turnover will be up to 3 crores. On a professional side, the same logics will apply. Your professional turnover will be 50 lakhs. But if you're 95% in permissible modes, then you have to take a turnover of 75 lakhs. Please, in the question, watch out for the word sales. Yes, watch out for the word sales. When you get a compulsory question, when you start a table, always look on the right side. If the sales value is anywhere below 2 crores, 3 crores, 50 lakhs or 75 lakhs, hold back and check for presumptive before you proceed forward. Yes, next comes your capital gains. Income tax says when it comes to capital gains, and if it's an unlisted bond and debenture, before 23rd July, this asset can become a long-term capital gain. If the period of holding is more than 36 months. But if the asset is transferred after 23rd July, this asset will always be a short-term capital asset. Will never become a long-term capital asset irrespective of a period of holding. However, people notice that even if it's a long-term capital gain, it does not matter. You will not get any indexation benefits. You will not get any indexation benefits, which means even if this asset was transferred before 23rd July, no indexation will be granted on unlisted bonds and debentures. Those are specifically restricted. Next, if you come to indexation, where and all can you not claim indexation? We just discussed. 1. You cannot claim indexation on any unlisted bonds and debentures. 2. You cannot claim any indexation on slump sale. 3. You cannot claim any indexation on depreciable assets. You cannot claim any indexation on depreciable assets. 4th, you cannot claim any indexation on 112A gains. 112A gains. And 5th is the amendment of current year if the transfer took place after 23rd July. If the transfer took place after 23rd July. These are the 5 cases where you cannot claim any indexation benefits for your exams. Even if the asset is transferred before 23rd July. Yes, even if the asset is transferred before 23rd July, unlisted bonds, slump sales, depreciable assets and 112A were never eligible for indexation even in the past cases. Next, if you are going to have an asset which is transferred before 23rd July but taxable on receipt, people, these are your exceptional rules. Exceptional rules of insurance compensation, compulsory acquisitions, conversion of capital asset into stock in trade. Notice carefully that in these kind of questions, the taxability will arise on the date of conversion or acquisition as the case may be. But the tax will be paid only when the money is received. In these questions, if the question comes and says that the asset was transferred before 23rd July, but the money alone was received after 23rd July, you will tax it after 23rd July, but based on old laws. But based on old provisions, you cannot tax it based on new provisions. Yes, so pay attention to this. Next comes your immovable property rules. Immovable property rules about how to compute capital gains, specifically when an asset is sold after 23rd July. I'll be rolling out a separate video where I'll be giving you the whole format of immovable property rules, people, so you can watch that video for your attention. At this point of time, let's quickly revise. Immovable property rules, if it is sold after 23rd July, the amendment of current year comes and clarifies that you will check tax on both the regimes. You will check tax at the rate of 20% with indexation and check tax at the rate of 12.5% without indexation, and tell me where the tax is lower. That is what you will end up paying as taxes. Next comes your exemptions under section 54, 54F and 54EC. Income tax says if you're planning to transfer any house property to buy a house property, you'll get an exemption under 54 if you invest capital gains. You can get a maximum exemption of only 10 crores. If you're going to do a 54EC, then you will have to invest your net consideration in order to buy a house property. But here, the maximum investment will be 10 crores. Notice that in 54, the maximum deduction will be 10 crores and 54EC maximum investment will be 10 crores. If you're going to, this is also 50 lakhs. Okay, this is 54EC. I'm sorry, people. When it comes to 54EC is bonds, and therefore you will have to again invest your capital gains. And you'll get an exemption of rupees 50 lakhs. Under 54F is what you will have to invest your net consideration and take a maximum investment claim of only 10 crores. That is what the exemptions are. Yes, please correct it from my side as well. When it comes to buyback, people, the amendment of current year, therefore please pay attention to this. Buyback provisions come and say that whatever full value of consideration you have will be fully taxable as IFOS dividends in the current year, which means whatever money you receive in the current year will be fully taxable as IFOS dividends, and whatever cost of acquisition you have will be treated as your capital loss. Whether short term or long term, depending on the period of holding. Yes, so if a buyback question comes, whatever money you receive will be fully taxable as dividends, whatever cost you paid will be fully treated as long term or short term capital loss. That is the amendment of current year. Pay attention to this. Next, income tax says IFOS, where IFOS comes and says assets which are not taxable as gifts. People understand there are only 3 assets which are taxable as gift. One is money. Second is your specified movable assets. Specified movable assets means bullions, archaeological collections, paintings, any work of art, shares in securities, scriptures, any kind of drawings, and any kinds of jewelries. And third is your immovable property. Only these assets are treated as taxable for gifts. Any other assets like mobile phone, laptops, your washing machine, fridge, and all those things are fully exempt. They will not be taxable. Then comes your deemed dividend provisions, people, 222E, which comes and says that if you are going to be a private company and you are going to give any loans and advances to your shareholders, if the shareholder is holding more than 10% voting power, whatever loans and advances you give to him will be fully taxable to the extent the company has accumulated profits Yes, so if the company has any accumulated profits, whatever accumulated profits the company has will be fully taxable in the hands of the shareholders as deemed dividends to the extent the loan is given to him. Notice the second deemed dividend amendment in the current year, which is buyback, which is what we have discussed earlier. Yes, great. We are almost at the end, people. Stick with me. Let's do it together. We are at adjustment number 35, which is clubbing provisions. Income tax says if a salary is paid to a spouse, in a concern in which you have at least 20% voting power, the salary will be clubbed in your hands. If you can prove that the spouse does not have any technical qualification. Yes, so income tax comes and says that if a person is having no technical qualification and is working in the entity in which the spouse has 20% shareholding, then the spouse will take the salary clubbing. Notice carefully that the clubbing will only happen after granting standard deduction. So please ensure that you grant a standard deduction before you club it in the hands of the spouse. When it comes to minor child, people, income tax comes and clarifies all incomes of minor child are taxable in the hands of parent whose income is higher. All incomes are taxable in the hands of parent whose income is higher, except for 3: when it is because of any skill, when it is because of any manual labor, or if the child is a handicapped child. These are the 3 reasons alone where it will not be taxable in the hands of the parents. It will be taxable in the hands of child. If it is taxable in the hands of parents, you will get an exemption of rupees 1,500 per annum per child for the parent, only under ATR, not under DTR. So that is also something to be kept in mind. Next comes your losses chapter, people, where income tax says when it comes to losses, can a speculative business loss be set off against PGBP? The answer is no. You cannot set off any speculative loss against PGBP income. A speculative loss can only be adjusted against speculative income. When it comes to PGBP loss, can you set off PGBP loss against speculative profits? Yes, there is no restriction on PGBP loss. There is only restriction on speculative loss. So please note this carefully. Next comes your CG loss. Income tax says CG loss are of 2 types. One, you have long-term capital loss, and one you have short-term capital loss. If it is long-term capital loss, you can set off against long-term capital gains only. But if it is short-term capital loss, you can set off against any capital gains. Next comes your critical amendment, people, of adjustment number 39, section 80 CCD, NPS scheme. NPS scheme comes and says that when it comes to NPS in the current year, an employer can only contribute up to 14% of the salary. If he contributes more than 14%, it will be disallowed under PGBP. When it comes to employee, whatever salary has been given as NPS will be fully taxable under the head salaries. But you can then go on to chapter 6A. And claim a exemption, claim a deduction. What are the deductions, people? They say for the employer contribution, you can claim up to 10% of salary. If you are following ATR. You can claim up to 14% of salary if you are opting for DTR. But to the extent the employee has contributed, first 50,000 is fully allowed as deduction. Anything excess which is paid can be claimed up to 10% of salary. But these provisions will only apply under ATR. No claims under DTR. That is what the NPS scheme is. Yes. So what is the NPS scheme, people? First of all, from an employer's perspective, you can only contribute up to 14% of salary. Anything excess which you contribute will be disallowed under PGBP for the employer. Under employee, whatever money is received from the employer will be fully taxable as salaries, and then you can claim a deduction under chapter 6A, where if it is employer's contribution, you can claim 10% under ATR and 14% under DTR. But if it is employee's contribution, the first 50,000 will be fully allowed as deduction. Anything excess will be allowed up to 10% of salary only under ATR. These provisions of employee are not eligible for DTR. Then comes your ATD, people, where income tax says if you are going to have any preventive health checkup, then you can claim a deduction of rupees 5,000. For all people put together. But when it comes to medical insurance will be split separately for self, spouse and dependent children, and split separately for parents. and split separately for parents. This bucket will get 25,000 ka deduction. This bucket will get 25,000 ka deduction. But if any bucket has a senior citizen, that bucket will get 50,000. That bucket will get 50,000. Notice carefully that this 5,000 rupees is a part of the bucket, which means you can't claim over and above 25 and 50. That is a maximum limit. Also notice carefully, people, that the 5,000 rupees can be claimed as deduction even if the payment is made in cash. But these payments can only be claimed as deduction only if it is made by permissible modes. Only if it is made by permissible modes, you will not get that deduction otherwise. You will not get the deduction otherwise. Yes. Then comes your provisions of section 80G, where provisions of section 80G come and say that you can claim donations in 4 categories. Category number A, which talks about your ministers and nationals. If you have any minister and national donations, then it is 100% allowed as deduction. If it is any prime minister drought relief fund, you are allowed for 50% deduction. If you have any kind of Olympics or any kind of family planning donations, then it is 100% subject to a qualifying limit. And if it is any kind of charitable organization, it is 50% subject to qualifying limits. The qualifying limit is 10% of your total income. It is 10% of your total income as a donation limit. Notice when you compute total income, only ignore one component, which is 80G. The whole 80G will be ignored for computing your total income, and then you will compute 10% on it. That 10% is your donation limit, which you can maximum donate. Please notice that if you want to claim deduction under 80G, you have to make payments more than 2,000 rupees by permissible modes. If you make payments more than 2,000 by cash, no deduction will be granted to you. Next comes 80JJAA, the important provisions. The important provisions of 80JJAA come and say that if you have recruited new employees, whatever salary you are paying to the new employees, 30% of it can be claimed as deduction. Subject to certain conditions. Condition number 1, employee should have worked for at least 240 days. Employee salary should be less than 25,000 rupees per month. Your employee should be contributing to PF. And you should be having a tax audit applicability on you. If these 4 conditions are satisfied, you can claim 80JJAA deduction. Final thing, people, which I probably forgot, is that whatever salary you are paying to the employee should be paid only by permissible modes. If the salary is not paid by permissible modes, no deduction will be granted on 80JJAA. Yes. Next comes your ROI chapter. ROI chapter comes and says that if you are going to file a return of income is mandatory in what cases? People, there are cases which is important for your 4-mark question. Cases number 1, if your basic exemption limit is exhausted by your gross total income. So if your GTI, ignoring your capital gains exemption, is more than basic exemption limit, return filing is mandatory. If not, you will still be filing return of income if certain conditions are satisfied. You have deposited more than 50 lakhs in savings account. You have deposited more than 1 crore in current account. You have paid more than 1 lakh rupees in electricity charges. You have paid more than 2 lakh rupees in foreign travel. Your business turnover is more than 60 lakhs. Your professional turnover is more than 10 lakhs. You have a TDS in your 26 years showing more than 10,000 rupees. More than 50,000 rupees in your senior citizenship. And 40,000 rupees in your non-senior citizenship. And if you are going to have any assets which are held outside India, or if you have any signing authority in any bank outside India, in all these cases, return filing becomes mandatory. What happens if you don't file your returns on time? First, you will be levied for a 234A interest. Second, you will be levied for a 234F late filing fee of rupees 5,000 if your total income is more than 5 lakhs, and 1,000 rupees if your total income is less than 5 lakhs. Third, you cannot claim any carry forward of losses. Except for HP and UD. HP and UD can be carried forward. Anyone else cannot be carried forward. Fourth, you cannot claim any heading C of chapter 6A. What is heading C of chapter 6A? Your 80QQB, 80RRB, 80JJAA. These 3 deductions will not be granted. Also, you cannot claim any 10AA. SEZ deduction. And the last thing which ICA makes an assumption is that the person can only opt for DTR. So pay attention to this question. If a question comes where the person does not file his return on time, unless the question specifically mentions, it is assumed that the person is going for DTR here. It is assumed that the person is going for DTR here. Then comes adjustment number 45. Adjustment number 45 talks about cases where the previous year and assessment year is the same. There are 5 cases where previous year and assessment year will become the same. A theory question. Case number 1, if the business or profession is discontinued in the current year. Case number 2, if you are a non-resident shipping company which is traveling from outside India to India. Case number 3, if you are an AOP or BOI which is created in the current year and is dissolved in the same year. Case number 4, if you are planning to discharge, sell, transfer, charge your assets with an intention to evade taxes. And case number 5, if you are going to be an individual who's leaving India with no intention of coming back. In all these 5 cases, your previous year and assessment year can become the same. Theoretical question. 45 adjustments, people, to complete your chapter. After this, 5 more adjustments which I want to discuss with you in order to make this chapter complete. First, 46. What happens if the question does not mention a regime? What happens if the question does not mention a regime? This is what I told you. If the question says that the return is filed late, then assume you are in DTR. If the question says that the return is filed late, assume you are in DTR. But if the question does not mention anything about the return, you will have to do both the regimes. You will have to do both the regimes and check where the tax is lower Do not make an assumption if nothing is mentioned in the question, people. You will have to check for both the regimes and check whichever is lower. Next, what happens if the question mentions that the income is net? It means this income is after deducting TDS. It means the income is after deducting TDS, and therefore you will have to gross up the number, which means if the question comes and says that you have received winnings net, it means it is after deducting 30% TDS. Therefore, gross it up and make it 100% to report the right income. What happens if the question comes and says that the salary and rent is received per month? If the question says that the salary and rent is received per month, it means it is without any standard deductions. So, which means grant the standard deduction of 50,000 or 75,000 under salaries and grant the standard deduction of 30% of NAV under HP if the question does not mention. Next, the last thing which you need to check, people, is the current year. That in current year, if the question mentions any SEZ, the SEZ should only be working in the 6th year of operations. Meaning from the current year, the SEZ should only get a 50% deduction on its export profits. If you arrive at a scenario in the current year where the profit is showing 100% or the business is in the first 5 years, you will say no deduction under 10AA directly. 10AA, if at all is coming in the current year, can only come for a 50% deduction. If a 100% deduction is coming to you, then say no deduction for 10AA. But if you're claiming a 10AA deduction, always check for AMT in the question. And the last and the critical adjustment is that if the question comes and gives you chapter 6A deduction, please do not claim any chapter 6A on capital gains. Claim chapter 6A only on slab rate incomes. So if you get an MCQ question where they come and say there are multiple incomes and they have also claimed chapter 6As, the chapter 6A will only be adjusted against the slab rate incomes. Any excess will be ignored. And then you will compute taxes. While compute taxes, please also ensure that you adjust the basic exemption limit of your capital gains first and then compute taxes. If there is any 112A on it, please ensure you don't claim rebate on that. Awesome. That is top 50 adjustments which you need to be taking for your exams and going forward, people. I'm looking at my time slot. We are at 37 minutes. So yes, 50 adjustments we have done in 37 minutes. Great job. Tell me all in the comment section, people, how many adjustments were you able to answer properly. But yes, please do not spam it. You have enough studies to be doing for your exams. So pay attention to that. I hope this video was useful for all of you. All the very best for your exams, people. If there is anything which I can support with you, any doubts which you have in the next 2 days, please feel free to reach out to me and I should be able to support you with the best extent possible. Yes, thank you, people. Have a great learning and I want to see you soon coming up to CA finals and telling me some good news. Yes, take care, everyone. Bye-bye.